There are so many rules out there when it comes to personal finance and how to manage your finances in a way that you can get to financial freedom. In this video, I'm going to break down the 50, 30, and 20 rule, and you might be already familiar with it, but what I do is take it a step further, how you can really optimize this process so you can get to early retirement a lot earlier. If you're interested, keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, occasionally I make some whiteboard videos which just breaks down finance in such an easy to consume way that it makes you feel great because you're learning something, makes me feel great because I get to have another excuse to wear this black t-shirt and talk to a camera. Now with that, let's jump in. Now what we're going to talk about is the 50, 30, 20 rule, and we need to understand that despite this being somewhat common knowledge for most people watching, a lot of people aren't doing this. And this I feel like is a very basic way to look at your personal finance and your budgeting. So we're at the start of the year. I'm not sure when you're watching this, but it is still relevant. If you don't know what this is, have this as your baseline when it comes to your budgeting and make the adjustments in accordance with this 50, 30, and 20 rule. So what exactly is the 50, 30, and 20 rule? Well, it means that when you get paid, you allocate 50% of your net income towards needs. Needs would include rent, mortgage repayments on your own house where you're living, things like insurance, rates, groceries, things that you really need to survive. 30% is wants, and this could be anything from Netflix to going to a cafe and having the extra latte that you don't really need, or going out there shopping for a dress or for a new suit or a new shirt that you really could go without. So these are wants. Now it's important that you do have wants because at the end of the day, we aren't robots. I definitely spend a lot in terms of wants, and some of it is questionable, but this is part of living. You don't want to just be some sort of robot that goes out there and says, oh, I'm going to save all my money and then invest it. No, it doesn't work like that. What you want is a balance because then it becomes sustainable. Then what you have is 20% that's allocated towards savings or investing. Now, ideally, we would have this switched around where 50% or a majority of our income is actually used to invest, but we're definitely going to touch on that in a little bit. And what we have here is just illustrating the 50, 30, and 20, 50% being half the pie, which is going towards needs. The yellow is the wants at 30%, and then 20% is saving and investing. And it just gives you a visual representation of how little you're actually putting towards savings and investing. And the thing is, people aren't even doing this. So if you're ahead and you might be saving or investing about 40 or 30%, you're well ahead of the majority when it comes to investing and saving. If we can have this as a baseline, I think we're going to do quite well, but keep an open mind as we go through this video. Now here's an example. Again, your situation could be different. You could be making less, you could be making more, but on an average 90K income per year, that would be $1,300 a week after tax. So it's very important we know what the difference is. If you're getting taxed, then there's no point because you're not actually seeing that money come through. So if we use the 50, 30, 20 rule here, that would mean that $650 a week is going towards our needs. 30% is going towards our wants. So $390 could be towards going to the restaurant, going out with your friends, whatever it may be. And then 20% is left over, which is $260 a week, equating to $13,520 per year towards investing and saving. And the question I have for you is you've got to question whether that's enough. Now, living in an environment where inflation's going through the roof, grocery prices are so much higher than where they were 3 years ago or 2 years ago. I would know because about 3 years ago I moved out of home, and it just seems like that's when prices started going up for everything. But by simply saving this $13,000, and you might be by yourself making this $90,000 income, and $90,000 for some may seem like a stretch, and for others is way below what they make. But 90K is still 90K. And although it buys you a lot less today than it did 10 years ago, it is still a significant amount. So what we want to do is utilize what we have today to be able to build out a better future for ourselves. So we realistically have two options. We can go and reduce our expenses, or we can increase our income. Now, why we want to do this is because I feel like this number here of 13,000 or 13,520 is really not enough to get us to financial freedom. And we can both agree on this.
Yeah, I'm assuming you just nodded there.
And that's why we have the two options. Now, reducing your expenses is a smart thing to do. You can use a budget, go and see, is it really necessary to do X, Y, and Z? But I'm definitely in the camp, and I've always approached it this way, is that instead of me trying to reduce my expenses, limit my lifestyle, and not really enjoy life, I'm going to end up finding myself regretting a lot of the moves I make. So if I'm in my 20s, my 30s, or 40s, there's a lot of stuff that I want to do that I can do right now that I probably can't do when I'm 60, 70, or 80. So for me, it's about enjoying today and how do we have that balance today as well as building for tomorrow. So I'm I'm definitely in the camp of increasing the income relative to reducing the expenses. Yeah, so I'm definitely all for reducing one of the streaming services if I don't need it, but at the end of the day, I want to be able to go and enjoy the life. How do I increase their income? So, making an extra $10,000 a year, you might hear about that and you're like, I make 90K, an extra 10K isn't going to change my life. Well, it may not change your life today, but it will have a significant influence on your retirement, early retirement, and financial freedom. And I'm about to show you how. First thing is to address how do we actually make the extra $10,000 a year. You have a couple of options. You've got the side hustle, you've got the second job, you've got a partner and maybe they're making some money as well. And then you've also got a promotion at your actual job. So if you enjoy it, you're probably doing a good job there. It might be worthwhile asking for a pay rise or working your way up the corporate ladder. Now, any of these could work for you, right? A combination of these would be even better. Imagine having a partner, getting promoted at your normal job, and then having a side hustle or a second job. Like, you're getting the best of all worlds. But I want to break this down so that we're just using simple numbers just to illustrate how important an extra $200 or $300 a week is going to be. And I promise you, after this portion of the video, your approach to investing as well as making an extra $10,000 is going to change forever. So stay with me. Now, at $13,520, let's say you did that for 1 year and you've saved up all that money. Now what you do is you say, I'm going to do the same thing for next year, except I'm going to put 13K into some shares, and some people like to do ETFs and things like that. So you go ahead and you put 13K plus you're DCAing in $260 a week. Now, obviously, if you're getting paid monthly, you'll only be able to do it monthly. But in this case, if you did it weekly, that's what it would look like. Now, if you averaged out at a 7% growth rate over 30 years, your portfolio would be worth $1.42 million. Now, yes, in 30 years from now, 1.42 isn't going to buy you much, right? But it's still going to get you into a position that's far superior than most people ever will. And it puts you in a position of power. So for you to have the independence, not relying on a pension, having some vision around what you're wanting to do long term is very important. But here's where it changes. Here's where an extra couple of $100 a week is going to change the way you approach investing. If you were to go ahead and say make an extra $10,000 in year one, you would have $23,520 to invest year one. So let's say you go ahead and do that. Then you DCA the $260 from your current job, and then you have the extra $192 per week, which is the extra $10,000 broken into weekly payments. And if you did that for the exact same period at the same rate, you would be left with $2.47 million. That is almost double what you were getting in option one. So if we had a fancy graph here to illustrate the point, it would be a significant difference between where you were or where you could be, and having that extra $10,000 means an extra $1 million in 30 years time. So almost $2.5 million in cash. Even if you went and put it straight into the bank, and let's say the bank rates at the time were 3%, you'd be making about $75,000 every single year. It's a very special position to be in, especially if you can pay off your house during that time as well, plus have gone out and invested. It gives you some breathing room. Now, all of this stuff, you may go, oh, this is pretty beginner stuff, or I'm learning something new. If you are learning something, the oxygen for me to make these videos is that like button and subscribing. So if you can do that right now, that would be amazing, because it means that I know you guys are enjoying this sort of stuff, so I'll make more of it, right? Now, what I want to do is go and take it a step further. Now, this is the advanced side of things, and I hope that you've stuck around to go, what else can I do to level up? I don't want to retire in 30 years. I may want to do it in 15 years. How do I go about doing that? Well, a couple of simple moves can actually result in that, and that is the power of compounding interest, plus it's the power of you getting in earlier. So what could that look like? Well, you would go out and buy real estate, right? And we're a real estate channel here. So obviously for me, it's a big factor in my own personal wealth is how do I get the right properties in the right location? Now, for me personally, I've done everything myself, but we now have a team and we've been doing it for almost 3 years where we help clients build their own portfolio. So if you're watching this and sort of going, well, that sounds great, and I want to buy real estate, but where do I find something for $450K that's going to yield a positive cash flow plus going to grow? So if you are interested in that, you'll find my email in the pinned comments down below, as well as a link to my website where you can just go ahead, look at what we do at Search Property as the buyer's agency. Now, what we can do is we go ahead and purchase a property for say $450K. Now, you might buy one for $400, you might buy one for $500. The max value I would go in today's market would be $500K. Anything above that, I think you're wasting your time. But again, that's my personal opinion. Now, on a purchase like this for $450K, you should be at approximately $100 per week in extra cash flow. So after all of your expenses, you've got the income coming through with the rent, you should have about $500 $5,000 every single year in positive cash flow. Now that's in year one. As the rents increase, you are going to have a significantly better cash flow as the years go on. But for this purpose, we're just going to leave it at $5,000 and just assume the rents aren't going up, but they definitely will. Now at 5% growth, which is again quite conservative, at 5% growth, you're growing at about $22,500 per year on that one property. Now again, we will have rents increase, so you will have more cash flow as you go through. But straight away, you can say, well, if I need to have an extra $10,000 a year going towards investing, I could go and purchase one property and that gives me $5,000 in year one. Now, after about 3 or 4 years, you're probably at about $10,000 anyway. But where the beauty of this works out is when you can compound that and use the equity from properties to grow. And I've got plenty of videos on this channel, so definitely go check out that video. I'll link one up here as well. So you can go ahead and see how it all breaks down, how I can build out a portfolio and how that machine pays me and grows my wealth for me. So the goal would be 4 to 5 properties. So let's just go with 4 properties, which would equate to about $1.8 million. Now that means an extra $400 per week. And it also means, more importantly, that this $1.8 million at 5% is going to be growing at $90,000 every single year. Now again, we know growth is not linear. So some years might be negative 2%, other years could be 12%, and it sort of averages out, maybe it would be 5%. But again, very conservative. So let's say you were to go and build out this portfolio worth $1.8 million. You're now making $90,000 a year in equity. In addition to that, you're making about $20,000 in positive cash flow. So you're doing double what we initially said, which was the $10,000 extra a year. Plus, you also have the machine growing at $90,000 a year, and that's not affecting your own income. Now, again, as soon as you sort of look at that and say, well, I've got a $90,000 income, how am I able to afford $1.8 million worth of real estate? Again, it does assume that your income increases. As well as that, you might have a partner, you might buy with siblings, where you're able to grow out this machine a lot quicker as well. But what is crazy about doing it this way, and this is where I think less than 1% of people will actually go and achieve. You might be someone that's in this boat where you think you can do it and you need the extra help, you should definitely reach out. It's to go, how do I do this option? Because if you're able to do this after 30 years, you're left with $7.7 million. So going back to our first few examples, in the first example, you're going out there saving what you can from your normal income, you're at 1.42 million. You go out there, make an extra 10K, your dollar cost average, you're left at 2.47 million. You do this by going and saying, in third option, buying a real estate portfolio of just 4 properties. And I know a lot of clients already have bought 4 properties with us. So this is quite achievable, is to go, well, I'm going to end up with a portfolio worth $7.7 million. Plus your money is against hard assets. I personally prefer property over shares because I don't like paper assets. It's a personal choice, but then the barriers to entry with property are a lot higher. So you need a deposit, you need to go out there, do the research properly because you're going out and getting a loan. And in some cases, you can't even get a loan because your borrowing capacity isn't there. So there are pros and cons to that. But more importantly, I want to go and build wealth in the traditional method, but I want to do it with leverage in an environment that I know quite well, which is real estate. That's why I run a buyer's agency. But that's effectively personal finance 101 when it comes to the 50, 30, and 20 rule. People will go out there and say, well, this was a very simple video. And for others, it's mind-blowing. I think the simplicity of this is what catches a lot of people out, because you can go out there and do budgets, but if you aren't actually executing on that, you're not getting to financial freedom. My job here for you, in return for you watching my videos, is how do I go and do the baseline, and then how do I have the advanced side of things, which is where I really want to step it up, get to the 1% of the 1%, which is essentially financial freedom and retiring early, because that is definitely not something that everyone can attain, unfortunately, and it's something that I'm super passionate about, which is why I bring out videos every single week. I hope you guys have enjoyed this one, and if you have, subscribe and share it with someone that, you know, really needs this sort of information, and I'll catch you guys in the next one. Thanks, guys.